Okay, so hello everyone, and thank you for attending today's webinar discussion. Um, Before we get started, I just want to make sure I put this disclaimer out there that everything that will be discussed is education purposes. So I am not here to convince you, more just to educate you on, what kind of policies are out there and, some of the reasons behind those policies. And during this time, if you're in the live, you can ask questions, or if you're on the webinar itself, you can put in the Q&A tab throughout the discussion, and I'll be happy to answer those as I go through this. So let's get started. Now, again, I started this off by making sure people understand that you don't want to spend years investing your hard-earned money only to leave it all to a life insurance company. So what we're going to do is discuss the type of life insurance that policies are out there you can choose from to make all the difference when it comes to your overall financial plan. So a little bit about myself. Again, my name is Veronica Phillips, for those of you who do not know who I am. And I am an educator in the financial department. And I work with financial companies to assist in educating families about the financial planning resources that are out there. So I recently retired from the military. I served 22 years. And I wanted just to make a changing impact on the lives of families by eliminating debt, planning for their future, and create financial wealth. This type of education or resources was never introduced to me, not in the depths that I've learned now throughout my 22 years and even during my childhood. So my goal is to empower families to make informed financial choices through education and to make sure I match them with the right type of financial solution. So that could be life insurance, investments, auto and home insurance, and more. And I can help them also achieve their financial goals. So let's get into today's discussion and topic. So what is life insurance? Well, just for textbook purposes, life insurance is a type of insurance policy that provides financial protection to beneficiaries upon the death of the insured person. So it is designed to provide a death benefit, which is a sum of money that is paid to a designated beneficiary or their estate in exchange for regular payments made by the policyholder. Now, the primary purpose, again, of life insurance is to offer financial security and support to loved ones of the insured individual in the event of their death. And the beneficiaries can use the death benefit to cover those various expenses like funeral costs, mortgage or rent payments, their outstanding debt, education expenses, and day-to-day living expenses. Life insurance policies come in different types, including term insurance and permanent insurance. So these are the two types. Now there's variations to all of these policies, but the basic type is either a variation of a term or a variation of a permanent, which we'll discuss. So term insurance has a coverage for a specific amount of time, which typically ranges from 10 to even now 35 years. And it pays out a death benefit if the insured person actually passes away during that term. Permanent, on the other hand, offers coverage for an entire lifetime of the insured person, which also includes a cash value component that grows over time. So when you're considering life insurance, individuals will typically assess their financial obligations, such as their dependents, outstanding debts, and future expenses to determine what type of coverage best works for them. Premium life insurance policies do determine the various factors that includes things like your age, your health, your lifestyle, your occupation, and those things can also determine the amount of coverage you can get with the prices. So now we're going to get into the different types of policies. So we're going to talk about the term policy and the permanent policy. So let's discuss about the term. So term life insurance is a type of life insurance policy that provides coverage for a specific period of time. Now we're going to kind of get into some of those characteristics. As you can see, policies can range between 10, 20, 30, and even now, depending on your carrier, 35 years. And again, just as we mentioned, pays out the benefit if that person actually passes away during that term. So now we're going to get into like the characteristics. So this is what makes a term policy a term policy. So coverage duration is the first one. The term life insurance provides coverage for a specific amount of time, typically ranging from 1 to 35 years. The policyholder will select the term at the time of their purchase, and the coverage is active during that entire duration. The next characteristic is a death benefit. So, in the event the policyholder's death or they die during that term, a death benefit will then be paid out to the beneficiaries. The death benefit is a predetermined lump sum of money that the beneficiary receives tax free. The next characteristic is the premiums. So the premiums for term life insurance are generally lower compared to permanent policies. They can be paid monthly, quarterly, annually, and in some cases, some people pay lump sum all at once for the entire term. Then you have a renewable and convertible. Now, a lot of people don't even realize that this is actually an option for term policies. So renewable, many term life insurance policies offer the option to either renew their policy, or if the carrier has that option, they can convert it to an actual permanent policy. Now, although premiums most likely will increase because again, when you renew it, it's going to be based on your age at the time you renew your policy. It does give you that option to continue to renew as long as you feel like you need it. And although some policies have conversion features that allow a policyholder to convert their policy into a permanent insurance policy, they might have to undergo a medical examination, or they won't have to undergo a medical examination. So that's the whole purpose of renewable, is that if you got it at a certain time, you were extremely healthy, when you renew it or convert it, you still can renew the policies or convert those policies without actually having go through a medical exam. So here's one of the main factors or main components of a term policy: no cash value. So unlike permanent life insurance policies like whole life or universal, term life policies do not accumulate cash over a time. If the policyholder outlives their term, there is no payout or return of premiums paid to them. Now, coverage amount is another characteristic. So the policyholder determines the coverage amount known as the face value or death benefit. At the time of purchase, it is usually based on the policyholder's financial needs, such as replacing income, paying off their debt, or providing for dependents. Another characteristic is the simplified underwriting. So term insurance policies often have simpler writing processes compared to permanent. While some policies may require medical examination, there are also options available with simplified underwriting that only require maybe just a few health-related questions. Another characteristic is temporary coverage. So again, term life, as we mentioned, provides temporary coverage. At the end, if the policyholder wants the coverage beyond that, they would usually have to renew the policy or convert it to a permanent policy, or just purchase a whole new term altogether. It's important to note these specific terms and features of a policy will vary depending on the company that you select. So these are just basic characteristics of what defines a term as a term policy. So let's get into the permanent policy. So what is a permanent policy? A permanent life insurance policy is a type of life insurance policy that provides coverage for the entire lifetime of an insured individual as long as the premiums are being paid. So now we're going to get into the characteristics of a permanent policy. So the first one is the characteristic is lifetime coverage. And unlike term life insurance, which provides coverage for a specific amount of time, permanent life insurance covers an individual for their insured entire life. As long as the premiums are paid, the policy remains in force until the insured dies. Cash value accumulation is part of the permanent. So here's one of their characteristics. Permanent life insurance policies often have a cash value component, which allows the policy to accumulate cash over a time. A portion of the premiums will go towards the cash value, which grows on tax deferred basis, and then the other goes towards the policy itself, and they can access this cash value through withdrawals of loans during their lifetime. Another characteristic is fixed premiums. So permanent life insurance policies generally have a fixed premium, which remains same throughout the entire life policy. What this does is it provides stability and allows policyholders to plan their financial commitments accordingly. Another characteristic is the death benefit. So permanent life insurance policyholders offer a death benefit that is paid out to the beneficiary upon the insured's death. The death benefit is typically tax-free, and it can provide financial support to insured loved ones, such as paying off debt, covering funeral expenses, or providing an inheritance. And the next characteristic is policy customization. So permanent life insurance policies often provide flexibility in customization options. So what they can do is choose the death benefit around the frequency of the premium payments, and they may have the option to add riders and endorsements to enhance their coverage. These additional features can include options like accelerated death benefits, which allow the policyholder to access a portion of their death benefit if they're diagnosed with a terminal illness. The next characteristic is potential dividend. So some permanent life insurance policies, such as participating whole life insurance, may offer a potential to earn a dividend. Dividends are a share of insurance profits, which can be received by the policyholder as cash, used to reduce premiums or reinvest to increase the policy cash value's death benefit. Another characteristic is estate planning benefits. So permanent life insurance can be a valuable tool for estate planning purposes. The death benefit can help cover estate taxes and provide liquidity to the estate, ensuring the smooth transfer of assets to beneficiaries. So it's important to note that specific characteristics and features, again, of permanent insurance can vary depending on the companies and policies you choose. So now we're going to get into universal life. Now, universal life is a version of a permanent policy, but because this one is highly used, especially the index version of this, I want to also give those characteristics so you kind of understand what a universal life policy is. So universal life insurance is a type of permanent life insurance that provides a combination of a death benefit and savings or investment component. It offers policyholders flexibility in premium payments and the opportunity to accumulate cash value over time. So let's get into their characteristics. So the first characteristic is a death benefit. So like all other life insurance policies, universal life insurance provides a death benefit that is paid out to the beneficiary upon the insured person's death. The death benefit can be customized based on the policyholder's needs. Now, the next characteristic is premium flexibility. So universal life insurance allows policyholders to adjust their premium payments with certain limits. They can choose to pay more than required premiums, which builds up cash value over the policy, or pay less when financial circumstances are tight. Another characteristic of a universal life is cash value accumulation. So universal life has a savings or investment component, as they call it, a cash value. A portion of the premium payments is allocated to the cash value account, which earns interest or returns based on the policy's underlying investments. Now, the cash value grows tax deferred, meaning you don't have to pay taxes on the growth until you actually withdraw it. And then another characteristic is withdrawals and loans. Policyholders can access their cash value of their universal life policy through withdrawals or loans. Withdrawals are tax-free up to the total amount of premiums paid into the policy, but loans against the cash value accrue interest, but are not subject to income tax as long as the policy remains in force. And then another characteristic is adjusting the death benefit. Universal life insurance allows policyholders to increase or decrease their death benefit with certain limits, often without requiring medical examinations. The flexibility can also be useful if financial needs or circumstances change over time. Another characteristic is cost of insurance. So universal life insurance policies have various options for the cost of insurance, which is the portion of the premiums that goes towards covering the death benefit and policies administration costs. So policyholders can choose between guaranteeing cost of insurance or more flexible that may be subject to periodic reviews. Another characteristic is riders and options. So universal life policies often offer additional riders and options that can be added to customize the coverage further. Examples do include accelerated death benefit riders, which allow a portion of the death benefit to go to the insured if they're diagnosed with a terminal illness, and long-term care riders, which provide funds for long-term. Now, I will say it is important to note that universal life policies are one of the more complex ones, and its performance of the policy's cash value is tied to what they call underlying investment. So before purchasing a universal policy, it is very advisable to carefully review the terms and conditions and understand the fees that is involved, and consult with a financial professional to ensure that it aligns with your specific goals and needs. By the way, all of these things are outlined in every illustration that is given to you when it comes to these permanent policies. So there's a chart that's always given to you, and it has all of this information at the back, and it always has all these numbers You should consult with someone who actually has the understanding and background experience to break that down to you so that you understand what it is that your policy is really offering you and what it's not. Now, life insurance policies can be very complex financial products depending on the policy you have. And there are several facts and myths that are associated with all of them. So, what we're going to do now is break down those common facts and myths about term and permanent policies. So, first, let's talk about the facts. Let's talk about things that are true about a permanent policy. So, it does provide lifelong coverage. That is true. Permanent life insurance provides coverage for an entire lifetime of the insured as long as premiums are being paid. Here's another truth that it does provide cash value accumulation. Now, permanent policies often have a cash value component that accumulates over time. This cash value can be accessed or borrowed against during the insured's lifetime. Another fact is that their premiums stay level. So again, a permanent policy's premiums, the premiums stay level throughout their entire policy's lifetime. Another fact is the death benefit payout. So permanent policies do offer a death benefit that is paid directly to beneficiaries upon the insured's death that provides financial protection to loved ones. And then the last one is this is a fact, is their tax advantage. So cash value growth within a permanent life insurance policy can grow on a tax deferred basis, meaning the policyholder does not pay taxes on growth until they actually withdraw the funds. Now, let's get into some of the myths. These are things that are actually false, that are thrown out there for people to hear or people say, but this is actually not true. So here's one myth, is that permanent life insurance is always the best option. Now, while permanent life insurance has advantages, it may not be the best option for everyone. So some of the key factors that go into life insurance is affordability, coverage needs, financial goals should be considered before you actually purchase a permanent policy. Another myth, something that's been thrown out there that is not true, is that cash value is equivalent to an investment. This is false. So you'll hear a lot of life agents that will tell you that cash value is either better, it is an investment, or it's equivalent. This is false. While permanent life insurance policies may accumulate cash value, they are primarily insurance products and should not be seen as standalone investments. So cash value growth is often modest compared to the dedicated investment vehicles that are out there that help you grow your income. Another myth is that is put out there is that it guarantees returns. Now, although some permanent life policies do offer guaranteed cash value, the returns are typically lower compared to investment options that are available for you. Another myth is that policies are unchangeable. Again, permanent life insurance policies can often be modified or adjusted based on changing needs. For example, the death benefit premium, payment schedule, and coverage that can be altered. Another myth, this is what you'll hear out there all the time as well, is that everyone needs permanent life insurance. This is a false. The need for permanent life insurance varies depending on an individual's circumstance. Again, for factors such as dependence, financial obligation, and estate planning goals should be considered before you decide on the type of life insurance coverage you will need. Now let's talk about some facts of universal life. Now, again, I told you that this is a permanent version, but I do want to make sure people understand what universal life offers, because this is one of the more sought out policies for permanent policies today. So let's get into the facts versus the myths. So the first fact, universal life policies provide a death benefit and cash value component. So this is a fact. A portion of the premium payments goes towards the cost of insurance, and the remaining amount is invested, accumulating cash value over time. Another fact is that universal life policies offer flexibility in premium payments. Policyholders can choose to pay premiums above the minimum required to build cash value faster, reduce or skip premiums if the cash value is sufficient to cover the cost of insurance. Another fact about universal life is that cash value in universal policies can grow on a tax deferred basis. So the investment portion of the policy accumulates earnings that are not subject to immediate taxation, providing potential advantages for long-term growth. And then another fact is that policyholders can access their cash value in a universal policy through loans or withdrawals. However, these options may affect the death benefit and may be subject to interest charges or penalties. Now, as we talk about the facts, we are going to also talk about the myths, the things that people say that are true, that are in fact false. So myth number one is that universal life policies always provide guaranteed returns. Now, while some policies, again, offer guaranteed interest rates, others may be subject to market performance and have variable returns based on the performance of underlying investment. Another one that's thrown out there that's not true is that universal life policies are suitable for everyone. Again, universal life insurance is not a one size fit all. And you'll see people out here try to tell everyone it is. It's typically more complex and expensive than term insurance. And it's important to assess your financial goals, risk tolerance, and insurance needs before deciding on a policy. Another myth, a false that's out there is that cash value in a universal policy can guarantee significant return. I think I've seen this one said more by life agents than anything else. Now, while the cash value can accumulate over time, the investment performance is subject to market conditions and policy fees, which can impact the growth of potential. It's crucial to carefully review the policy's illustrations and projections to actually understand the potential outcomes. Again, there is a lot of life insurance agents that cannot break down that illustration that's outlined in the back of those contracts, but you can get with someone that has a financial background that can actually break this down to you to understand it and see if you're actually making money or losing money. And then another myth that people throw out there is that universal life policies are the best way to invest for retirement. Again, this is false. Now, while the cash value components of a universal life can provide a source of funds for retirement, it is important to consider other investment options like retirement accounts that are actually built for retirements, like 401s, IRAs, that may offer tax advantages and potentially higher growth opportunities. So let's take a look at this illustration, and it breaks down how universal lives are actually broken down. So I created this illustration just to give you guys a visual because I'm a visual learner, and I think sometimes it's easier to visually see things to understand it. But it doesn't matter which universal life policy you get. It could be an index universal life. It could be a universal life. This is the basic components of the policy and how it's broken down. So the first thing you got to understand is that universal life policy premium rates, they increase annually, and it's based on what we call an annual renewable term. And all that means is that every year as you get older, your premiums for your cost of insurance will go up. Now, your fixed rate, which is $100 a month, will not change. However, inside of that policy, your insurance will. So when you look on here, at the age of 25, what you see is that the cost of insurance for a 25-year-old is $25. The expenses for that policy is $5, and then everything else will go into the cash savings account. Now, as they get older, that means the premiums or the cost of insurance is going to go up. That $25 is what's actually covering the $100,000 death benefit. As this one's going to fast forward 20 years later, as you can see, now they're 45. And guess what happened? Now their policy insurance coverage is $90. They're still paying $100 a month. And now their expenses went up as well. So how much money 20 years later is actually going into their cash savings account? Nothing. It's breaking even. So that means that the only thing that's moving and maneuvering the market is the market performance. So if the market is doing well, they'll make, money. But if the market is doing bad, then they don't make anything. They don't lose money, but they don't make money. So this is what's happening to your account as it's literally, as it's aging. Now let's talk about 20 years later around the time of retirement. Your policy now, you're at the age of 65. So as you can see on this chart, the cost of insurance actually is more than what you're paying on premium coverage. Again, they're not going to reach out to you and they're not going to say, hey, your policy is now worth $175. So we're going to charge you an additional $75. What they're going to do is they're going to take that from the cash savings account. So as you can see, your cost of insurance is $175. You still have expenses that go up every single year, but now you're losing money in your cash savings account. So what does that mean? It means if the market is not performing, you're actually losing that year. If the market is doing well, you're going to make based off of whatever is still being pulled. But every single month after this age, you're literally losing more and more money out of your cash savings account. This is what a universal life components are. This is what makes a universal life be able to function the way it does. Legally, they have to charge expenses. They have to, their cost of insurance goes up every year because a universal life contract is based on annual renewable term contract, which if you understand what that is, again, it's a term contract. That means that It's a policy that renews every year based on your age, which means your premiums go up every year based on your age. So this is outlined in the illustration, but sometimes people do not know how to read this or they don't know how to explain it. And then eventually people will cancel these policies because they're actually losing money versus investing and making money. Now let's get into term policies. First, we're going to talk about the facts, and then we're going to talk about the myths. So here are some facts about term. So again, it is a fact that term insurance covers for a specific period of time. We've already discussed this. It could typically range between 10 to 35 years. Another fact is that term life insurance is generally more affordable than permanent life. Another one is that life policies offer death benefit payout to beneficiaries if they pass during the term. The death benefit from a term policy is usually paid out in a lump sum. Term life insurance policies do not accumulate cash. Insurance is often used to provide financial protection for a specific amount of time, like covering mortgage or child education expenses. So if you've ever heard that mortgage protection, this is like one of those policies that usually are used for that. Premiums for term life insurance policy are generally lower when the insured is younger and in good health. That is a fact. Term life insurance policies can be renewable or convertible. Again, there have been thoughts that it wasn't, but allowing the insured, it does allow the insured to extend coverage into a permanent policy or renewal policy. Another fact is that term life insurance policies require medical underwriting. They may require medical underwriting, which means that an applicant may need to undergo a medical examination or provide health information. Every carrier is different. Every carrier will have terms, as in if you do need a medical evaluation versus if you just need the basic medical screening. But every one of them has those rules. And then again, another fact is that life insurance can provide peace of mind and financial security for insured loved ones in case of an untimely death. So now that we talk about the facts, let's also talk about the things that are not true. Now, here's some myths that are thrown out there. Term life insurance is a waste of money, and if the insured outlives if they outlive the policy term. So this is a myth, you guys. The fact of the matter is that while it's true that term does not provide payouts if the insured survives the term, it still provides valuable protection if you have a financial plan. Again, a lot of people do not include financial plans when they have term policies, but if you have the right financial advisor, consultant, educator, they will definitely make sure that the financial plan actually meets this term policy. Another myth is that only young and healthy individuals can qualify for term insurance. The fact is, while premiums may be affordable for young and healthy, term life insurance is available from people all different ages and health conditions. Premium rates do vary based on individual circumstances. So I will tell you, I've helped people who are young. I've helped people in their 60s. I've helped people who have had health conditions. Term is available for everyone. Another myth is that term life insurance is too complicated to understand. Here's the fact of it, is that term life insurance is actually the most straightforward compared to all the other type of life insurance policies out there. The coverage period and death benefit amount are clearly defined in the contract, which makes it easier to understand compared to all of these other permanent policies out there that have different rules and stipulations. Another myth is that it's better to invest the money instead of buying term life insurance. Now, while investing can be a smart financial strategy, term life insurance provides a specific financial strategy net for your loved ones in case of your premature death, and it serves as a different purpose than investment vehicles. And then the last one is, of course, you don't need term insurance if you have an employer-provided coverage. Here's a fact: while employer-provided coverage, life insurance can be beneficial, it usually does not. And this is usually a fact that is usually not sufficient enough to cover all your financial needs. Additionally, coverage from an employer can end if you leave that job. And then, of course, you've got to read the contracts because there are also very complicated contracts out there for work ones. So having an individual policy definitely ensures continuous protection. Now, what I'm going to do now is I'm going to break down this illustration. We're going to take a look at it, and there's going to be a couple of illustrations after this because it does help to kind of understand, life insurance in a different way. So I will explain how this correlates with life insurance at the end. But for now, what I want you to do is just look at Bank A, which we're going to call the loan bank, and Bank B, that we're going to call the own bank, and decide which bank works best for you. All right, so we have Jane. who banks with Bank A, which we will call again the loan bank, and we have John, who banks with Bank B, the owner bank. Both Jane and John are looking to begin an investment with an account deposit of $100. So they're looking to put $100 into their account to start investing. Now, Bank A tells Jane they'd be happy to set her up with her investment, but Bank A also tells Jane for her account to grow, she'll have to invest for 3 years with Bank A and they keep her money. I want y'all to hear that again. They'll invest with her. She can invest with them for 3 years, but they are going to keep all of her money. Now, after 3 years, one of the things the bank does guarantee is that they will give her 3 to 4% growth for her income for her investment account. Now, Jane gets reassured that while her money is investing, it's going to be protected, and her 3 to 4% growth is guaranteed annually. So she's like, okay, I can do this. So she starts to invest into Bank A. Now, across town, John walks into Bank B, the owner bank, and he sets up his investment account. Bank B then welcomes John and lets him know that his account is active immediately. And each month that he deposits $100, it will be credited towards his investment account as it's, while it's, going against the market or going with the market. So not only that, but their investment company averages 10 to 12% gains annually. So his account is going to be included in that investment with no additional fees or expenses. Now, based on the information that I just gave you, Jane and John, both of them, they started their investment account on the same day. But here's the difference. Jane's account won't earn investment gains for 3 years, while John's investment account started on day one. Not to mention, Jane's investment is only averaging 3 to 4% growth, while John's is averaging 10 to 12. Now, tell me, as an investor, as someone who is looking to invest money between Bank A and Bank B, would you choose Bank A or would you choose Bank B? All right, so what we're going to do now is we're going to fast forward just a little bit. 15 years later, both John and Jane have been putting $100 into their investment account. And now they both have an emergency situation that requires them to take out $10,000 from their investment account. So we're going to start with Jane A. Jane A goes to the bank and tells them she needs to withdraw $10,000 from her investment account. And Bank A is happy to assist her, but they tell her it will take roughly 6 months for them to access her funds and have them properly funded to her. Jane is a little upset. Why would she be upset? I mean, because she needs that money right away. So bank informs her again that it's outlined in her contract and there's nothing really they can do to expedite it. She's just going to have to wait that 6 months. So what does Jane do? Jane finds ways to make her situation work while she waits for her money to come in. Now, 6 months later, Jane receives a call from Bank A who tells her that her money is ready for her to use and she needs to go to the loan department to withdraw her money to create a payment plan to pay that money back. Remember, Jane decided to put her investment into the loan bank. So what does it mean? It means that the bank that she has to loan money for her to use money. At the bank, she is ready to sign her repayment plan and she sees where her repayment plan comes with a 6 to 8% tax rate. So what does that mean? It means that she'll have to pay her $10,000 back with interest. Now let's go across town. Again, we see that John is doing we see what John is doing at Bank B. Let's go across town to see what John is doing at Bank B. So at Bank B, John walks into the building and he tells them, hey, I have a situation and I need to withdraw $10,000 from my investment account. Bank B is happy to assist him and tells him it'll take 1 to 2 business days for them to have his money available. John is thankful. He is happy on how quick the turnaround is for him. But here's the best part. Because John put his money into the ownership bank, that means that the money that he's been investing in day one belongs to him. He owns. So what does that mean? There's no additional fees, there's no loans, there's no payback required. His money is just that, his. So again, when you're talking about this emergency situation between Jane and John, would you still invest with Bank A or would you invest with Bank B? Now, here's one more kicker, and we're just talking about pure investment right now. I ain't even talking about all the other things that get added, but here's the last kicker to this entire scenario. Now, Bank A has one more thing that's in their contract because they're a loan company. Because they are a loan bank, if you don't use your investment money before you die, you lose it. Ain't that crazy? So you've been putting all that money in, but you don't get, if you die before you ever use it, your family can't have access to it. The bank gets to keep it. Now, why is that? Because the bank is a loan bank. It means that you came into our bank, you volunteered to allow us to use your money to help you grow so that if you don't use it by the time you die, we keep it. We keep all of it. Just imagine if you had 20, 50, 70, $100,000 in that bank. And if you don't use it, you lose it. Now, again, there are variations out there that allow you to actually give money back to your family, and it definitely costs a whole lot more. But this is just a basic, again, illustration to understand how this works. Now, on the other hand, Bank B is an ownership bank. So what does that mean about his money? If he dies prior to using his money that he saved, guess where his money goes? It goes to his family. It goes to his estate. So again, because he invested in the ownership bank, his money is still his, meaning if he dies prior to using it, his money still is his. It belongs to him. So with all that again broken down, would you choose Bank A or Bank B? Which bank would you choose? Now, what if I told you that everything that I just described with Bank A is a permanent policy? What if I told you every permanent policy all falls under Bank A? Would that make you look at your insurance contract differently? This stuff is outlined in your illustrations. This stuff is outlined in the charts. This stuff is outlined in your contract. If you knew all of this was happening when you needed your money, would you still invest in Bank A? Remember this, permanent policies and cash savings accounts are owned by insurance companies. None of the money that you're investing in these insurance companies or their accounts are in money markets. They are not investors. They're not ran by investors. They're ran by insurance companies. And because insurance companies manage these accounts, they create their terms and conditions, which is why no contract has one way of doing everything when it comes to these permanent policies. Every carrier, every company has the means to create their contracts how they want to based on the needs of their insurance company. How many of you knew this information? So again, if all of this is happening at Bank A, right? If they're taking your money, if they're using your money, if they're putting all these rules and stipulations and giving you very low interest rates, why do people get these policies? Why do they get these policies that really don't benefit the insured? One of the reasons why is because I'll give you this. Life insurance agents are really good at what they do. Life insurance agents are really good at explaining what they need to explain to you for you to get the policies. But these policies are only in place because it pays those life insurance companies and those agents well. Has nothing to do with the customer, really, the consumer. The individuals who get these policies and try to convince you on this investment side is only doing it for their own personal gain. That's it. That's why these policies exist, and they're legal. As illegal as they shouldn't be, they're legal. And by the way, I've had a whole policy, I've had a universal life policy, and a term policy. So I have all three contracts. And I'm telling you, when you review your contract, you realize that there's a lot of information in there that your life insurance agents do not explain to you for a reason, especially the ones that want you to invest, as they call it. Guys, I'm not here to convince you. I'm just here to give you guys actual valid information. That is true. These are components. So I'm not making these things up. These are components when it comes to certain policies. And by regulations and laws and things like that, there are certain things they have to do to remain in compliance. And these are those things. Now let's take a look at another illustration that explains again what the main purpose of life insurance is used for. So let's use the same name, Jane and John, and their daughter Jan. So Jane and John both make $3,500 a month, and which combined is about $7,000 a month of household income. Jane and John, they own a home where they pay mortgage. They have 2 cars where they pay on monthly. They have insurance coverage on their home and cars. They both have credit card debt, utilities that they take care of home. they have groceries that they have to pay for monthly, daycare expenses. But with all of this, they pay roughly about $4,500 a month on their bills. Now, an unexpected thing happens. Again, John suddenly passes away. Now that Jane is left to pay 4,500, now Jane, sorry, is left to pay $4,500 worth of bills with a $3,500 monthly income. So tell me, can Jane sustain this lifestyle that her and John created for herself without income protection? I mean, my math, I was good at math, let me not lie. But you do the math of this, tell me this, does that make sense? Can she literally pay $4,500 with $3,500? We know she can't. So what happens next in this scenario if she doesn't have income protection? Jane, you guys got to remember, Jane is grieving, but life still goes on and things still have to be done. So while she's grieving, now she has to potentially consider selling her home that her and her husband bought. And that wasn't supposed to be a short-term home. That was supposed to be their long-term home that they could potentially give to Jan. Her husband has a car that isn't fully paid off. So now she has to find a way to sell his car and still maybe potentially in the process of selling his car, pay the monthly income on that. That can potentially reduce her insurance, but she still got to sell it first. And then what about the debt that her and her husband created? Does that go away? Because he died, do the creditors all of a sudden say, hey, by the way, we're going to, credit you this and you don't have to pay this? No, that debt still has to be paid. Utilities still have to be paid for the house that she's currently living in until it's sold. And what if the market is bad? I'm talking about groceries that still got to be done. She has a child, so childcare is still a must because she works. You're talking about additional stressors on someone. This is what typically happens when you don't have income protection. So what happens with no income protection? What will this family lose? A lot, right? So let's recap. The primary purpose, again, of life insurance is to provide financial security and support the loved ones of insured individuals in the event of their death. Financial security is income protection. So I like for people to think about it this way. Here's a rule of thumb, and this is typically what you should consider when you're talking about financial protection. Income protection is typically 10 times the annual household income. And what does this do? It gives your family 10 years of sustainable income in the event one or both individuals or family members pass. So let's go back to the scenario. Let's go back to Jane and John's situation. If both Jane and John made $3,500 a month and they decided to do income protection, then what do? They multiply their income times 12, which gives them both $42,000 annually. Now, if you multiply that by the rule of 10 that we just talked about, that means Jane and John would both need roughly $420,000 worth of coverage to protect their financial security. So what does this do? It gives both Jane and John 10 years of guaranteed income if either one of them passes or both of them for the next 30 years. You see how income protection works and how it benefits this family? This is what life insurance really is created for. This is what income protection does for your family. It's not intended to pay things right away. It really is intended to protect the family for a longer period of time while that individual figures out what to do next. And a lot of people are underinsured because they don't have income protection included in their financial plans. So with this, wouldn't Jane been able to take care of the mortgage for the next 10 years? Yes. Would she be able to pay off the credit cards, utility, take care of her childcare? Yes. Why? Because they are still being covered for $4,500 worth of monthly bills for the next 10 years. So how amazing is that for Jane? Now she gets time to finally breathe. Now she gets time to take care of herself, her wellness, and her transitioning, becoming, a household of two to a household of one. That's what income protection does. So let's look at this breakdown of what we call the theory of responsibility and why insurance protection is needed early on and not so much later on in life. So this illustration, again, it could be modified to apply to all types of lifestyles. But since we've been talking about married with children scenario, we're going to kind of use that for this. So of course, when you were young, you get married, you have children. So what does that mean? It means that with children and being married, what do you have? You have daycare, you have additional, you're feeding more people, you're buying more clothes. For some of your kids, some of you are paying for their college, or you're paying for your own college. And for some of you might also have loans, car notes, credit card debt. And maybe you decide to purchase a home as a family. So what does this mean? It means that all of these things very early on is going to put you in high debt. And since you're young, typically you don't have a lot of money saved up in some kind of retirement investment account. So while you're working, what do? You start to put money away. Now, if one of these spouses pass away early on in life and they lose that income, that loss of income could be devastating to that family, which is why protection is very, high protection or amount of protection is needed early on. Now, let's fast forward though. Let's talk about later in life, after you retire, or maybe you're close to retiring. What happens now? Your children are grown and living on their own for most people. You no longer have a car note because you paid it off. You might not have college loans or the loans that you've been, paying off for the years. You might still have credit card debt, but it's not as high because you don't have many responsibilities like you did when you were younger. And either your home is fully paid off or it's very close to being paid off. So what does that mean? Oh, not to mention, you've also had a chance to put money into your retirement account for like the last 20 to 30 years. So you've had enough time to allow that money to grow. So what does that mean? That means that what? Do you still think that you'll need the same amount of protection or coverage that you did early on in life? That answer is no. That is what the theory of decreasing responsibility really is. It just means that early on, you'll need more coverage or protection because you do have more responsibilities that require it to take care of your family, and losing that early on, or if someone passes early on, could sustain a high level of loss. And of course, as you get older, again, decreasing responsibilities just mean later in life, if you're still living, your decreased responsibilities, occur, which means that you don't have much left. You don't have many responsibilities. You don't have high debt. And you've been able to financially plan for retirement, which means you either need less coverage just for maybe the little bit of stuff you still have, or because you plan perfectly, you don't need more coverage at all. What life insurance company do you know breaks this stuff down to you this way? And also, what if you can eliminate having life insurance policies altogether? What if planning properly and accordingly means that once your term is up, or once your time is, that term is up, or that time is up, you no longer need coverage because you planned accordingly. That's where we come into this term that you might see thrown out there, which is buy the term and invest the difference. Now, buying the term and invest the difference just means it's just a term that is a financial strategy that involves purchasing term life insurance policies and then investing the money saved from it for a less expensive policy into other investment vehicles. So this concept behind this strategy is to obtain, again, the necessary life insurance coverage at lower cost while investing the difference that you were already putting into a policy into an actual investment engine that gives you higher returns. That's what buying the term and investing in difference really means. So how does it typically work? Well, one, you buy a term policy depending on your age, depending on how much. Again, financial planning is super important. I can't emphasize that enough. If you have a financial advisor consultant who actually creates a financial plan for you, it will tell you how much coverage you actually need when it comes to the term. But this is how it works. You buy a term. It could be 10 to 35 years of term, depending on your financial plan, your needs that you need. Then what you do is you save on the premium. So for someone who already potentially had a permanent protection, usually there's a difference on the amount of money you actually will get back in return. So you save that premium. But instead of putting that into your pocket, what you typically do is use that premium. But by the way, you were going to be paying for the rest of your life. You put that into an actual investment engine. And what that investment tool will do is it will, build your investment account. And then potential benefits is that by following this, you can actually achieve better advantages and things like that. So while you're still in protection, you're finding better ways to invest your money. Now, have you ever heard of the investment rule of 72? And if you're asking, yes, this rule does also apply to permanent life policies, and I'll explain in a second. So, what is the rule of 72? It's an easy way, really, to just calculate how long it takes for your money to double. So, what you typically do is you take the number 72 and you divide it by the interest rates you hope to earn. And I'm not going to say the word hope to earn. I'm going to tell you, you should divide it by whatever investment option you're currently using. And if you don't know, then what you should do is typically take like some kind of historical chart of the last 20 years and divide it by the average. And what it does, it will tell you how many years it will take for your investments that you have will double. If you take a look at this chart, you can see that a one-time contribution of $10,000 doubles 6 times more at 12% than it does at 3%. Now, why am I showing you this chart? Because if you remember early on when I talked about Bank A, which was the loan bank, they historically offered 3 to 4% investment growth on their cash savings account. So again, that's a cash savings account that's usually tied to a permanent policy. I want you to look at how long, just based off this example, how it would take for that policy to grow inside of it. So, let's just say you did put $10,000 into that investment account, that permanent policy. It would take 24 years before you can double that at a 3 to 4% growth. And that's what they call a guarantee. Now, again, the markets fluctuate, but most of these investment engines do not cap beyond 6 to 7%. And the average, even for like universal life policies, which a lot of people like to use for IULs, is 6 to 10% or 6 to 7%. And this doesn't, again, include the fees and the expenses and everything I just showed you on the previous chart when it comes to money that's actually going to start getting pulled from your investment cash savings once your premiums are more than what you put into your account monthly. I just want you guys to take a look at this real quick. And again, I want some of you guys to do a homework assignment. And if you have a permanent policy, I want you to go to your illustration charts. I want you to read your contract. I want you to read these things. If you don't understand those numbers, please reach out to me. I'd be happy to break it down to you and what it looks like for the next 30 years for you if you have a permanent policy. Now, again, the reason why I also talk about this is because Bank B, which is the ownership bank, typically, historically brings in 10 to 12% based on the investments that they do. So I want you just to look at this difference. Again, take all the examples I've been talking about and compare it to Bank A versus Bank B and tell me which one would you choose? Now, this is my last scenario before we end this discussion today, but I want to take you one more time to look how permanent and term really does work in some type of coverage scenario. So in this scenario, I want you to look at both John and Mary. They're both 35 years old, and initially they were with Bank A, which is the loan bank. Okay. John and Mary both have permanent policies worth $100,000 of coverage. They're currently paying $225 a month for that coverage. They're also using their personal banks to put IRA funding to put money aside for retirement, which gives a 1.5% growth, which currently has roughly $20,000 saved in it. Now they are paying an additional $105 for that account, which means that they're currently paying roughly about $330 a month on insurance, savings, and investments. Now, John and Mary finally got with a financial advisor or a financial planner who did a financial assessment for them. And they took into consideration their income. So they used their software, they put their income in it, they put their debt, their expenses, their financial goals, their retirement plans, they put all of that in there. And what they learned is that they were not properly covered with the right amount of protection for their financial needs. So, speaking with the financial consultant, what they found was they probably would have a better chance at a 30-year term, which decreases the amount of premiums they pay monthly. But again, they're going to invest the balance or the remaining money that they were already paying into an actual investment tool to see if they can grow their accounts bigger than 3 to 4%. So they went over to Bank B and they started their level term insurance policy. Now, if you don't understand what level term means, it just means it's a fixed price. So that means they're paying $80 for the next 30 years, worth $250,000 each for the next 30 years. So not only did they get term policies, they ended up getting more coverage which was what, $150,000 more. But they also, their premiums went down from $225 to $80 a month. So what does that mean? It means they started saving $145 more on their premium coverage. Now, again, the intent is not to bank that and do something else with it. The whole purpose of Invest the Difference is actually to use the same money again that you were going to put into your cash policy for the rest of your life, but now you're going to actually put it into an investment option. So that $145 is now going to go into an actual investment account that an investment advisor is going to select for them that guarantees them, or at least historically has shown to have growth of 10 to 12% for the next 30 years. Now, we're going to go back to these scenarios and we're going to look at Bank A again. John and Mary were initially paying what, $225 for $200,000 worth of coverage between the two of them. So what that means is that in 30 years, when they turn 65, they would have paid a total of $81,000 worth of premium for their protection and cash savings account. Now, I want you to look at the 3% chart right here very quickly and see in 30 years, give or take, how much money that is for $81,000 worth of premium coverage. Now, this does vary again. I always have to emphasize this is very depending on the type of investment tool you're using, but this is how much, they're making. And even with universal life policies, look at the 6%. That's kind of on average what they make. Okay. Now let's look at Bank B. If John and Mary did decide to get a level term policy for 30 years, they will pay $80 a month for $125,000 more coverage for both of them. But instead of paying, what was it, $81,000 for the next 30 years, they're only paying $28,800 for the next 30 years, which is a $52,200 difference. Tell me that doesn't make a difference. But again, throughout the 30 years, the intent is not for them to put that $52,000 back into their pocket. It's actually to put it into a proper investment tool. Because again, they were already signed up in contract to pay $225 for the rest of their lives. Like they already had that. That money was gone. That wasn't money that was coming back, because again, life permanent policies are intended to be charged for life. So we're not going to bank that $52,200. We're going to put it into, again, an investment engine as they went in Bank A. So now that $145 a month difference will go to an actual investment account. And they're also going to roll that $20,000 that's sitting in their bank, because the bank is only giving them 1.5%. So why would we want to keep that in there when there are investment engines out there that can grow your IRAs and your retirement accounts 10 to 12%? So they're going to roll that money into an actual proper investment account, and they're going to get 10 to 12% gains on their investment. So let's take a look at this chart just for demonstration purposes. Let's just make it easier to understand. So all we're going to do is just kind of use the example of their IRA investment. So they rolled it over into an investment growth account, as you can see here. So if Bank A caps at 3 or 4% by year 30, that means Mary and John would have accumulated $50,000 in this specific estimate. If John and Mary went to Bank B in the same 30 years while their policy is active and their accounts, are growing, as you can see, that's $640,000. That's significant, just based on the different type of income growth. This doesn't even include what we were just talking about, the $145 difference, because that is what the investing difference really means. But this is because their baseline started at $20,000, and then they include that additional $150,000. And oh, by the way, that $105 that was only getting 1.5% now is now getting 10 to 12%. So you're talking about $330 at a 10 to 12% market every single year to include on top of this. So this is just the baseline, as if they didn't put any more money in, but the whole point is to invest the difference. So you're talking about potentially almost $750,000, like 750 plus, by investing the difference, versus maybe a measly 70-something thousand dollars that would have continued to happen if they kept it in that cash savings account. You guys, I'm not making these numbers up. Historical numbers can show you that this is in fact true. So again, looking at this chart, isn't it safe to say that John and Mary have created enough income at this point to eliminate life insurance altogether in their 30 years? Do they really need to continue to pay, because in 30 years it'll be $65, so they probably would pay more. But do you really think that they would need additional insurance after 30 years when they banked almost $750,000 versus $50,000 that they would if they continue with their permanent protection. Now, again, when you outlive your protection, that doesn't mean your money in your investment account stop. It is still growing between the ages of 66 to 100 with a 10 to 12% growth versus it staying in your savings account. And, between the ages of 66 to 100, you're not only paying an additional $91,000 of premiums, but you're only growing your money every 24 years. So honestly, you're really making maybe $120,000, all from the ages of 35 to 100. How does that make sense? And why do people still continue to put their money into permanent policies when in their illustration, it shows this type of information? And lastly, do you think it's right for Bank A to keep your cash savings account if you die? So all this money you've been putting in because you outlived, you live long, you live healthy, and you just didn't use your coverage. Is it fair that because you didn't use any of your cash savings that if you die prior to using it, the banks get to keep it? Is that fair at all? Or if you want your family to have it, that you have to pay even more money you're putting in every single month? Again, just tell me how this makes sense. So with all this education that I just provided you, would you go with Bank A or Bank B? Would you still choose Bank A as your go-to versus Bank B? You tell me. This is all education, and everything I'm giving you is actually by the numbers. I'm not making these numbers up. All the verbiage that I gave you is actual textbook verbiage. So I'm not making none of this stuff up. I'm just making sure you understand how these policies work if you're trying to really, truly put your money and protect your family. So I hope you learned something valuable today. I'm always available with free financial assessments to look at your income. That's kind of what I'm here for. Everything I just talked about when it comes to your income, debt, expenses, whatever your financial goals are, to see if you're properly protected for you and your family. That's what I'm here to do and assist. My information is listed on this screen. You can either screenshot it, take a photo of it, or use the QR code and click on the link for a free financial assessment or just a life insurance quote based on your financial needs. If you kind of took the information we just took and you already know how much your family would need, we can do a quote to see how much it would cost. I will also be hosting again a full financial workshop on June 3rd virtually. So if you would like the information, you can join my Facebook community. The information will be posted in there. Again, you can scan this QR code and click on the contact us or join our financial community. And I'll look very quickly just to see if there's any Q&As before I end this. But if not, I am going to thank you guys for your time. Again, like I said, I hope you learned something very informational with the resources that I've just provided for you. I'll look in the chat real quick. I don't see any questions. All right. So thank you for taking the time today to hop on this. And I look forward to maybe helping some of you in the future. Take care.